Hello everyone, welcome to the 71st episode of me learning how to trade in Forex. So in the last video we went through knowing the three main groups of chart patterns. So we've got the reverse chart patterns, which include the double top, double bottom, head and shoulders, inverse head and shoulders, rising wedge, falling wedge. And we've got the continuation chart patterns, so they're the falling wedge, rising wedge, bullish rectangle, bearish rectangle, bullish pennant, bearish pennant, and then we've got the bilateral chart patterns. So we've got basically the triangle formations, the ascending triangle, descending triangle, and the symmetrical triangle. And now we are working on the chart patterns cheat sheet, which I think basically is going to summarize all the chart patterns we've done. So yeah, let's get started. Chart patterns cheat sheet. Chart patterns cheat sheet, so 11/03/2024. Like we promised, here's a neat little cheat sheet to help you remember all those chart patterns and what they are signaling. We've listed the basic classic chart patterns, when they are formed, what type of signal they give, and what the next likely price move may be. Check it out. Okay, so here's all the chart patterns we've done. Forms during whatever trend it is at, type of signal, reversal continuation, and the next move whether it's going to be down or up. So yeah, wait, there's a bilateral ones, aren't there? Bilateral are the triangles. Okay, they don't include the triangle set. Fair enough. You also might want to add this page to your bookmarks in case you need to double check those chart pattern signals before you risk your hard-earned cash on a trade. You never know when you're going to need to cheat. Haha. Bookmark this thing, yo. I might create my own chart pattern like a cheat sheet later on, so maybe. And as you probably noticed, we didn't include the triangle formation, symmetrical ascending and descending in this cheat sheet. That's because these chart patterns can form either in an uptrend or downtrend, and can signal either a trend continuation or reversal. Confusing, I know, but that's where practice and experience comes in. As we mentioned, it's tough to tell where the price will break out or reverse. So what's important is that you prepare well and have your entry/exit orders ready so that you can be part of the action either way. Cool, quiz time. Important chart patterns. It's time to find out if you know the difference between a double top, a wedge, a pennant, and a triangle. The head and shoulders. What does bilateral mean when talking about chart patterns? It means that there is no bias where the price is headed. Yep, correct. In the head and shoulders pattern, so that's the one that looks like that, the distance price moves after a break is usually equal to the distance price moves after usually is equal to it's not that. The distance from the high point of the shoulder to the neckline, the distance from the high point of the head to the neckline. It's a head, isn't it? Yeah. This chart pattern is very similar to the rectangle. It usually occurs when sellers or buyers pause to gather enough energy to take the price back in the same direction. The shape that price forms after a downtrend or uptrend is a small triangle. That's a pennant, isn't it? Yep. Which chart pattern is formed when price consolidates in a box after a downtrend, indicating sellers probably need to pause and catch their breath before taking the pair any lower? After a downtrend. In the box, the rectangles, they're continuation ones. So if it's a downtrend, then it's keep going to go down, so it's a bearish rectangle. Whenever price breaks out to the upside in the bullish rectangle, the move is usually about the same, about the same size. Where is a reasonable place to put your stop when trading chart patterns? 1 pip away from your entry price. Oh, never mind. What do you call a chart pattern that is formed when a valley is formed, followed by an even lower valley and then another valley equal to the first valley? That's the inverse head and shoulders. What do you call chart patterns that signal that the ongoing trend will likely resume? Continuation. Which type of chart patterns form when price consolidates between an upward support line and a downward resistance line? That's a rectangle, isn't it? Nope, never mind. Right, so that's a wedge. Number 3, what was number 3? I can't remember. I'll rewatch back this video and figure it out. Right, okay. So, Nexuson. So we're on to a different thing now. What are pivot points? Professional traders and market makers use pivot points to identify potential support resistance levels. Pivot points are used to identify potential support and resistance levels. Simply put, a pivot point and its support resistance levels are areas at which the direction of price movement can possibly change. So, a pivot point and its support / resistance levels are areas at which the direction of price movement can possibly change. Areas at which the direction of the price movement can change. Can possibly. Oh, hence the name pivot point. Right, okay, because it pivots the price into another direction. I'm assuming that's why. The reason why pivot points are so enticing is because they are objective. Objective. Oh, objective, because that means there's actually, it's not subjective, so there's no discretion involved. Pivot points are objective, not subjective. Unlike some of the other indicators that we've taught you about already, there's no discretion involved. In many ways, Forex pivot points are very similar to Fibonacci levels. Because so many people look at these levels, they almost become self-fulfilling. The major difference between the two is that with Fibonacci, there is still some subjectivity involved in picking swing highs or swing lows. With pivot points, Forex traders typically use the same method for calculating them. Many traders keep an eye on these levels, and you should too. Pivot points are especially useful to short-term traders who are looking to take advantage of small price movements. Just like normal support resistance levels, Forex traders can choose to trade the bounce or the break of these levels. Range-bound traders use pivot points to identify reversal points. So, range-bound traders use pivot points to identify reversal points. They see pivot points as areas where they can place their buy or sell orders. They see pivot points as areas where they can place their buy / sell orders. Breakout Forex traders use pivot points to recognize key levels that need to be broken. So breakout traders use pivot points to recognize key levels that need to be broken. For a move to be classified as a real deal breakout. For a move to be classified as a real deal breakout. Here is an example of Euro USD pivot points plotted on a 1 hour chart. So here's a 1 hour chart. PP, resistance 1, support 2, support 3, resistance 2, resistance 3. As you can see here, horizontal support resistance levels are placed on your chart. And look, they're marked out nicely for you. How convenient is that? Pivot point lingo. Here's a quick rundown of what these acronyms mean. PP stands for pivot point, S stands for support, R stands for resistance. But don't get too caught up thinking S1 has to be support or R1 has to be resistance. We'll explain why later. In the following lessons, you will learn how to calculate Forex pivot points, the different types of pivot points, and most importantly, how you can add pivot points to your Forex trading toolbox. Cool. Next one. How to calculate pivot points. Calculate pivot points. The first things you are going to learn is how to calculate pivot points. The pivot point and associated support resistance levels are calculated by using the last trading session's high, open, high, low and close. The pivot points and associated support or resistance levels are calculated by using the last trading sessions open, high, low and close. Since Forex is a 24-hour market, most Forex traders use the New York closing time of 5 PM Eastern Time as a previous day's close. Most traders use the New York closing time of 5 PM Eastern Time as the previous day's close. Pivot point calculation. The calculation for a pivot point is shown below. Pivot point is equal to high plus low plus close divided by 3. Support or resistance levels are then calculated off the pivot point like so. Resistance 1 is equal to 2 times pivot point minus low. Support 1 is equal to 2 times pivot point plus high, right? Minus high. You know what? I'm gonna take a photo, because otherwise me just writing them calculations out ain't gonna make much sense. Pivot point, resistance 1, support 1, resistance 2 is equal to pivot point plus high minus low support 2 is equal to pivot point minus high minus low. Third level support resistance. Resistance 3 is equal to high plus 2 times pivot point minus low. Support 3 is equal to low minus 2 times pivot point, high minus pivot point, high minus pivot point. Keep in mind that some Forex charting software plots intermediate levels or midpoint levels. These are basically mini levels between the main pivot point and the support and resistance levels. So we've got here pivot points are purple, or the blue line here looks like intermediate level between pivot point and support 1, intermediate level between pivot point and resistance 1, and I've got 3 intermediate levels there and 3 intermediate levels there. Right, okay. If you hated algebra, I have no fear, because you don't have to perform these calculations yourself. Most charting software will automatically do this for you. Just make sure you configure your settings so that it uses the correct closing time and price. We here at babypips.com also have our very own pivot point calculator. The Forex pivot point calculator can come in handy, especially if you want to do a little back testing to see how pivot points levels have held up in the past. Remember, one of the advantages of using pivot points is that it is objective, so it's very easy to test how prices react to them. Next up, we'll teach you the various ways in which you can incorporate pivot points into your Forex trading strategy. How to use pivot points for range trading. For range trading. The simplest way to use pivot point levels in your Forex trading is to use them just like your regular support and resistance levels. Just like good old support and resistance, the price will test the levels repeatedly. Just like regular support and resistance levels. Just like good old support and resistance, the price will test levels repeatedly. Price will test the support and resistance levels repeatedly. The more times a currency pair touches a pivot level then reverses, the stronger the level is. The more times a currency pair touches a pivot level then reverses or bounces back, I'm assuming, the stronger the level is. Actually, pivoting simply means reaching a support or resistance level and then reversing. If you see that a pivot level is holding, this could give you some good trading opportunities. If the price is nearing the upper resistance level, you could sell the pair and then place a stop just above the resistance. If a pivot level is holding, if the price is near the upper resistance level, sell the currency pair and place a stop just above the resistance. If the price is nearing the lower support level, buy the currency pair and place a stop just below the support. Just below the support. Yep, see, just like your regular support and resistance. Nothing hard about that. Let's take a look at an example so you can visualize this. Here's a 15-minute chart of GBP USD. So we got GBP USD 15-minute. We got the pivot point line here. Whoops, here. So it's currently, we got the support 1, resistance 1, support 2. So the price is pretty much near the support 1 or very close to support 1. Purchase just above support 1. So we buy just at this point here, and hopefully the price should go bounce back up again. Our targets is pretty much, I think our targets is going to be trying to get it within this zone. Put the stop loss below the support 2, just in case the price keeps plunging down further. Yeah, let's see what it says. In the chart above, you see that the price is testing the support 1 support level. If you think it will hold, what you can do is buy at the market and then put a stop loss order past the next support level. If you're conservative, you can set a wide stop just below the S2 or support level 2. If the price reaches past S2, the chances are it won't be coming back up. So both support 1 and support 2 could become resistance levels. If you're a little more aggressive and confident that support 1 would hold, you can set your stop just below the S1. As for your take profit points, you could target the pivot points or resistance 1, which could also provide some sort of resistance. Let's see what happens if you bought a market. So looks like support 1 held, so our stop loss didn't get triggered, which is at S2. It went back up. If you targeted to the pivot point, your take profit would have gotten hit. Yep, so hit there and then it could bounce down again, so then it automatically closes position here, and then you make basically the maximum profit you can make, because after that it goes back down again. And bam, it looks like S1 held as support. What's more, if you had targeted profit pivot point as your take profit point, you would hit your profit point. You mean your take profit? Hit your TP, I'm assuming it's meant to say. Woohoo, ice cream and pizza for you. Of course, it ain't always that simple. You shouldn't rely only on pivot point levels. You should also note whether pivot point levels line up with the former support and resistance levels. Should also note whether the pivot point levels line up with the former support and resistance levels. You can also incorporate a candlestick analysis and other types of indicators to help give you more confirmation. For example, if you see that a doji has formed over CS support or that the stochastic is indicating oversold conditions, then the odds are higher that S1 will hold its support. I think that's meant to say that S1 will hold its support. Also, most of the time, trading normally takes place between the first support and resistance levels. Occasionally, the price will test the second levels, and every once in a while, the third levels will be tested. Lastly, you should also fully understand that sometimes the price will just break through all the levels, like how Rafael Nadal breezes through the competition on clay courts. What will you do when that happens? Continue to hold onto your trade and be a sucker and watch your account dwindle away, or will you take advantage and get back some pips? In the next lesson, we'll teach you how to take advantage of when these levels break down. I was going to say use a stop loss, but I guess not. So, how to use pivot points to trade breakouts. To use pivot points to trade breakouts. Oh, I'm not 09. Whoa, 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 whoa. Just like your normal support or resistance levels, pivot point levels won't hold forever. Using pivot points for range trading will work, but not all the time. In those times that these levels fail to hold, you should have some tools ready in your Forex toolbox to take advantage of the situation. As we showed you earlier, there are two main ways to trade breakouts, the aggressive way or the safe way. Either method will work just fine. Just always remember that if you take the safe way, which means waiting for a retest of support or resistance, you may miss out on the initial move. Using pivot points to trade potential breakouts. Let's take a look at the chart to see potential breakout trades using pivot points. Below is the 15-minute chart of Euro USD. Taking the aggressive work would have worked here, away would have worked here. So it went up here, it went up here, or here as well. So I think every point where it shoots up to the next level would have worked. Resistance held initially, but then shot up again. If you were too aggressive here, you would have been capped out. Taking the safe way would have worked here. So waiting for the retest, I'm assuming. Capped out as in like it won't go up any further, it will just drop back down again, I think. Here we see Euro USD made a strong rally throughout the day. We see that Euro USD opened by gapping up above the pivot point. So here, like that bit there gapping up above, price made a strong move up before pausing slightly at resistance 1. So at here. Eventually resistance broke and the pair jumped up by 50 pips, so boom, like that. If you had taken the aggressive method, you would have caught the initial move and been celebrating like you just had won the World Cup. On the other hand, if you had taken a safe way and waited for a retest, you would have been the one sad little trader. The price did not retest after breaking resistance 1. In fact, the same thing happened for both resistance 1 and resistance 2, because it didn't drop back down again. Notice how Euro USD bulls tried to make a run for resistance 3 as well, so trying to go up here. Whoa. However, if you had taken the aggressive method, you would have gotten caught up in a fake out as the price failed to sustain the initial peak, or the initial break. So that bit there, basically, it dropped back down again. Where were we? If your stop was too tight, then you would have gotten stopped out. So that bit here, if your stop was like somewhere around here, then you would just instantly stopped out because it would go through your stop loss. Later on though, you'll see that the price eventually broke through, so that was here, this bit here. Notice how there was also a retest of the broken resistance line, which was the retest I think is here, so go like that. Yeah, it's that one there, yeah. Also observe how when the pair reversed later in the day and broke down past R3, so here, there was an opportunity to take a short on the retest of the resistance turn support turn resistance. Of resistance turn support turn resistance. So it turned back into resistance line basically. Which was there was on the retest of resistance turn support turn resistance. So resistance turn Right, I'm assuming it's going to be somewhere around here. Resistance, turn support, turn resistance. I think it's somewhere around here basically. Resistance, turn support, so it must have hit the bottom somehow. Resistance, wait, he said shorted the trade, so it must have been this one here, shorting the trade here. Resistance, so boom, turn support, boom, turn resistance. Probably. Role reversal, remember that when support levels break, they usually turn into resistance levels. This concept of role reversal also applies to broken resistance levels, which become support levels. These would have been good opportunities to take, I think I'll play it safe method. Support levels breaking, turn into resistance levels. Where do you place stops and pick targets for breakouts? One of the difficult things about taking breakout trade is picking a spot to place a stop. Unlike range trading where you are looking for breaks of pivot points, support and resistance levels, you are looking for strong, fast moves. Once the rate level breaks, in theory that level will likely become the support turn resistance or resistance turn support. Again, this is called a role reversal since the roles have been reversed. If you're going to go long and price broke resistance 1, you could place your stop just below resistance 1 because that resistance 1 has turned into your support. Resistance 1. God, I can't even say it now. Resistance 1 turned into support. Let's go back to the Euro USD chart to see where you could place your stops. So here, as for settling targets or setting targets, you would typically aim for the next pivot point, support or resistance level as your take profit point. It's very rare that price will break past all of the pivot point levels unless a big economic event or surprise news comes out. Let's go back to that Euro USD chart to see where you could put those stops and take profits. So we've got the thing here. So it was gonna go through here, so if we place the buy order here, it would shut up. So place our, oh right, so we're here, we'll place our profit targets, take profit level here, and our stop here, just below where we started buying basically, on also below the resistance 1. However much that is, I don't really know. The same with here, put your target in the next level, and then put your stop just a little bit below the support level, I guess, what you call it, support. Stop C will be here, take profit will probably be, well, there isn't a resistance 4 basically, but if we didn't know, I guess it would be the same distance, like around here maybe, probably, or maybe not, because it's the upper resistance level already, so you're not really going to have a resistance 4, are you? So yeah, in this example, once you saw price break at resistance 1, which is here, the green one, you would have set your stop just below resistance 1. If you believe that the price will continue to rise, you could keep your position and move your stop manually to see if the move will continue. You would have to watch carefully and adjust accordingly. You'll learn more about this later in lessons. So trailing stops, I think that's what they called it. As with any method or indicator, you have to be aware of the risks of taking breakout trades. First of all, you have no idea whether or not the move will continue. You might enter thinking that price will continue to rise, but instead you will catch the top or bottom, which means that you've been faked out. Breakout trading risks. Uncertainty regarding the price, regarding the price movement, regarding whether the price movement will continue or not. You won't be sure if it's a true breakout or just wild moves caused by the release of important news. Seconds, you won't be sure if it's a true breakout. Uncertainty regarding whether the breakout is a true breakout or just volatility due to release of important news. Spikes in volatility are a common occurrence during news events, so be sure to keep up with breaking news and be aware of what's on the economic calendar for the day or week. Lastly, just like in range trading, it will be best to pop on other key support and resistance levels. Don't just rely only on pivot points, support and resistance levels. Don't just rely only on pivot point, support, resistance levels. Resistance 1 is breaking, but you fail to notice a strong resistance level just past R1. Add on other key support and resistance levels. Important news. Therefore, be sure to keep up with breaking news and be aware of what's on the economic calendar of the day or week. Yep. Could be a fake out. So it'd be best to pop on. You might be thinking that resistance 1 is breaking, but you fail to notice a strong resistance level just past resistance 1. Price may break past resistance 1, test the resistance and just fall back down. You should make use of your Forex knowledge of support and resistance, candlestick patterns and momentum indicators to help you give stronger signals as to whether break is real or not. Add other key support and resistance levels. And also other strategies such as candlestick patterns and momentum and technical indicators. Cool. To confirm whether the break is real or not. So remember, I think in one of the previous lessons when we did the technical indicators, it told us like some traders only trade if like all the indicators they use line up with each other and agree with each other. Because there was that lesson when we learnt where like there was 3 technical indicators, but some of them don't even agree with each other. So there's one that says to buy, but then there's another one that says to sell, and there was another one that gives no signal whether to buy or sell. So I guess to like really be sure of whether the break is real or not, make sure all the technical indicators that you've used are lined up with each other, and also they all give out the same result. So yeah, okay, I am going to leave this episode here. So in the next video we're going to go through how to use pivot points to measure market sentiment. So yeah, thank you guys for watching, and I will see you then. Peace.